Assalamualaikum warahmatullahi wabarakatuh. We are from Group 6, Vindi Saputra, Tiara Flavia, and Izal Milatul. In today's topic, we will explain about equity analysis and valuation. So, enjoy the video.
First, we discuss about earnings persistence. A good financial analyst identifies components in earning that exhibit stability and predictability, that is, persistent components. We separate these persistent components from random or non-recurring components. This analysis aids us in producing reliable forecasts of earning power for valuation. Analysis also must be alert to earnings management and income smoothing. Earnings management and income smoothing can imply more stability and predictability than present in underlying characteristics. Company management often assert that such activities remove distortion or peculiarities from operating result. Identify this influence is important for us in assessing a company risk. This section considers elements bearing on analysis of earnings persistence, including earning level, trend, and components. Next, we discuss about recasting and adjusting earnings. Recasting also aims to identify elements included in current earnings that should more properly be included in the operating result of one or more prior periods. First, information on earnings persistence. Analysis of operating result for the recasting and adjusting of earnings requires reliable and relevant information. Major research of this information include the first, income statement, and the second is other financial statement and notes, and the third is management discussion and analysis. Next, recasting earnings and earnings components. First, recasting. Recasting aims to rearranging earnings components to provide a meaningful classification and relevant formula for analysis. Components can be rearranged, subdivided, or tax affected, but the total must reconcile to net income of each period. And the last about adjusting earnings and earnings components. The adjusting process uses data from recast income statement that are available in information to assign earnings components to periods where they most properly belong. We must be especially careful in assigning extraordinary or unusual items to periods. Also, the income tax benefit of a carry forward of operating loss should normally be moved to the year of the loss occurrences. Next, we discuss about determinants of earnings persistence. After recasting and adjusting earnings, our analysis next focus on determining earnings persistence. Earning management, variability, trends, and incentive are all potential determinants of earnings persistence. We also should assess earnings persistence over both the business cycle and the long run. First, earnings trends and persistence. Earnings that reflect a steady growth trend are desirable. We can assess earnings trends by statistical methods or with trend statement. And the second, we discuss about earning management and persistence. There are several requirements to meet the definition of earnings management. These requirements are important as they distinguish earnings management from misrepresentation and distortion. Earning management use acceptable accounting reporting principle for purpose of reporting specific result. And the last, we discuss about management incentive and persistence. We previously described the impact of management incentive on both the accounting and the analysis of financial statement. This is especially evident in us assessing earning persistence and in performing credit analysis. Experience show that some manager, owners, and employees manipulate their distort report earnings for personal benefit. Companies in financial distress are particularly vulnerable to these pressures. The last, we discuss about persistent and transitory items in earnings. Recasting and adjusting earnings for equity valuation rely on separating stable, persistent earnings components from random and transitory components. So we also discuss how they should be handled in evaluating earnings level, management performance, and earnings forecasting. First, analyzing and interpreting transitory items. The purpose of analyzing and interpreting extraordinary items is twofold. First, determine whether an item is transitory or less persistent. This involves assessing whether an item is unusual or non-operating or non-recurring. And the second, determine adjustments that are necessary given assessment of persistence. Special adjustments are sometimes necessary for both evaluating and forecasting earnings.
Next topic is about earnings-based equity valuation. Company valuation is an important objective for many users of financial statements, and here we will discuss accounting-based equity valuation and incorporate it within the analysis of financial statements. Relation between stock price and accounting data. And here's the formula, where BVT is a book value at the end of period T, and RIT plus N is residual income in period T plus N, where K is the cost of capital. The model above directly show the importance of future profitability in estimating company's value, that is, by using estimates of future net income and book values. Accurate estimates of these measures can be made only after consideration of the quality and persistence of a company's earning and earnings power. Next, we will talk about fundamental valuation multiples. Two widely cited valuation measures are the price to book or PB and price to earnings or PE ratios. Users often base investment decisions on the observed values of these ratios. We describe how an analysis can arrive at fundamental PB and PE ratios without referring to the trading price of a company's shares. By comparing our fundamental ratios to those implicit in current stock price, we can evaluate the investment merits of a publicly traded company. Okay, first we will talk about price to book or PB ratio. PB ratio is expressed as the first formula, market value of equity divided with book value of equity, and the PB ratio can be expressed in terms of accounting data, as you can see in the second formula. This expression yields several important insights. As future ROCE and or growth in book value increase, the PB ratio will be increased. Also, as the cost or risk of equity capital K increase, the PB ratio will be decreased. Recognize that PB ratio deviates from 1.0 when the market expects residual earnings, both positive and negative, in the future. If the present value of future residual earning is positive, the PB ratio will be greater. And if residual earning is negative, the PB ratio will be less than 1.0. Price to earnings or PE ratio. The PE ratio is expressed as market value of equity divided with net income. And PE ratio can be written as a function of short-term or STG and long-term growth or LTG of earning per share or EPS, as you can see in the formula. From the formula where K is the cost of equity capital, STG is the expected short-term, and LTG is expected long-term. Percentage change in EPS relative to expected or normal growth. When STG is greater than LTG and LTG is less than K, STG can be thought of analysis consensus 5 years growth rate in EPS and LTG as the long run rate of inflation beyond the forecast horizon. This equation yields two important insights. First, the P/E ratio is inversely related to the cost of capital. That is, it will be lower the higher the cost of equity capital, and the second one is the P/E ratio is positively related to the expected growth in EPS relative to normal growth. The P/E ratio doesn't say anything about the absolute level of earnings, whether EPS is higher or low. Only the rate at which EPS is expected to increase relative to normal expected growth.
The next point is about earning power and forecasting for valuation. Earning power refers to the earning level for a company that is expected to persist into the foreseeable future. With few exceptions, earning power is recognized as a primary factor in company valuation. Accounting-based valuation models include the capitalization of earning power, where capitalization involves using a factor or multiplier reflecting the cost of capital and its future expected risk and return. Many analyses of earnings and financial statements are aimed at determining earning power. Measuring earning power. Earning power is a concept derived from financial analysis, not accounting. It focuses on the stability and persistence of earning and earning components. Financial statements are used in computing earning power. This computation requires knowledge, judgment, experience, and perspective. Earnings are the most reliable and relevant measure for valuation purposes. Accordingly, valuation estimates must be credible and defensible, and we must scrutinize departures from the norm. The time horizon for earning power. The preferred time horizon in measuring earning power varies across industries and other factors. A typical horizon is 5 years and sometimes up to 10 years in computing average earnings. This extended period is less subject to distortions, irregularities, and other transitory effects impairing the relevance of a single year's result. A 5-year earning computation often retains an emphasis on recent experience while avoiding less relevant performance. Adjusting earning per share. Earning power is measured using all earnings components. Every item of revenue and expense is part of a company's operating experience. The issue is to what year we assign these items when computing earning power. In certain cases, our earnings analysis might be limited to a short time horizon. All items must also be divided by the number of shares used in computing earning per share. And the next is about the earning forecasting. A major part of financial statement analysis and valuation is earning forecasting. From an analytical perspective, evaluating earnings level is closely related to forecasting earnings. This is because a relevant forecast of earnings involves an analysis of earnings components and assessment of their future levels. We should consider interaction among components and future business conditions. We should also consider persistent instability of earning components. This includes analysis of permanent or recurring and transitory or non-recurring elements. The mechanics of earning forecasting. Forecasting requires us to effectively use all available information, including prior periods and earnings. Forecasting also benefits from disaggregation. Disaggregation involves using data by product lines or segments, and is especially useful when these segments differ by risk, profitability, and growth. We must also differentiate forecasting from extrapolation. Extrapolation typically assumes the continuation of a trend and mechanically project that trend into the future. The elements in earning forecasting. The first one is the current and past evidence. We forecast expected future condition in light of this evidence. Analysis must assess continuity and momentum of a company performance, including its industry. Another element is earning forecasting is checking on a forecast reasonableness. We often use return on invested capital for this purpose. If the earnings forecast yields return substantially different from returns realized in the past from industry returns, we should reassess the forecast and the process. Difference in forecast returns from what is reasonable must be explained. Reporting earning forecast. Recent years have witnessed increased interest in disclosure of earnings forecast by companies. We should recognize that management forecasting is different from forecasts made by financial analysis. The reliability of forecast depends on information assessed and assumption made. Use of management or analyst forecast in our analysis depends on an assessment of the assumption underlying them. And the next is about the interim reports for monitoring and revising earnings estimates. Interim statements are usually issued quarterly and are designed to meet users' needs. They are useful in revising estimates of earning power and earning forecasts. Yet, we must recognize certain limitations in interim reporting related to difficulties in assigning earnings components to periods of under 1 year length. Period and accounting adjustment. Determining operating result for a 1 year period requires many accrual adjustments and estimates. These year-end adjustments are often complex, time-consuming, and costly. Adjustments for interim periods are often less complete and use less reliable information than their year-end counterparts. This likely yields as a less accurate earnings measure for interim periods. The seasonality in business activities. Many companies experience seasonality in their business activities. Sales, production, and other operating activities are often unevenly distributed across interim periods. This can distort comparison of interim earnings. It also creates problems in allocating certain discretionary costs like advertising, research development, repairs, and maintenance. The integral reporting method. Interim reports are generally reported in a manner consistent with annual reporting requirements, adopting the view that quarterly reports are integral to the entire year rather than a discrete period. Practice requires accrual of revenues and expenses across interim periods. This includes accrual for inventory, shrinkage, quantity discount, and uncollectible accounts. The SEC interim reporting requirements. Several reporting requirements exist for interim reports filed with SEC. Principal requirements include: the first one is comparative interim and year-to-date income statement data. Second one, comparative balance sheet. Third, year-to-date statement of cash flows. Fourth, formal information on business combination accounted for as purchases. Fifth, conformity with accepted accounting principle and disclosure of accounting changes. 6. Management's narrative analysis of operating result. And the last, disclosure as to whether a Form 8K is filled during the period. The analysis implication for interim reports. The limited involvement of auditors with interim reports reduced their reliability relative to annual audited financial statement. Exchange regulation offers some, albeit limited, assurance. Yet not all reporting requirements for interim reports are necessarily best for our analysis. Therefore, analysis often emphasizes interim revenues as a measure of interim performance. Further, certain seasonality problems with interim reports are overcome by computing year-to-date cumulative numbers, including the result of the most recent quarter. That's all our explanation about equity analysis and valuation. We hope you all can understand about the material that we already explained in this video. Thank you for watching, and Assalamualaikum warahmatullahi wabarakatuh.